Okay, so today we are beginning with the standard SA 320, which is materiality in planning and performing the audit. Now, basically, when we talk about materiality, let us first understand the name of the standard. This standard tells us about something that is materiality. It is in planning and performing the audit. Okay, now, before we get on the details of the standard, I always believe in first understanding the idea behind the standard. We as auditors, we know that we have to give a reasonable assurance that the financial statements are to be free from material misstatement. So basically, given the inherent limitation of audit, that is, we do not have enough time to check all the transactions. And obviously, every transaction of a very small amount is not going to be really material. So we are not going to consider them in our evaluation. Therefore, it is very, very important for us to understand that we are going to concentrate on something called as the concept of materiality. So this materiality level is going to be set by the auditor because we are required to give a reasonable assurance regarding the financial statements being free from material misstatement. So we capture the word material misstatement. Correct? And because we use the word material misstatement, this standard is going to tell us that what we mean by the word material, when will the auditor set the materiality level, and most importantly, how are we going to evaluate the misstatement on this materiality? Correct? So with this, let us get started with the concept of materiality. First of all, the word material is something which is in a very simple language, seem to be important. Something that is going to be very important, very significant. Now let us take a very simple example of a company like Reliance. In a company like Reliance, when you look into the financial statements, the balance sheet, the profit and loss account, okay, and when we, the auditors, are going to perform the audit on the financial statements, tell me, if you compare Reliance with a regular business, a small scaled business that is there, will the material level for both of them be the same? Material as in something which is going to be influential, something which is going to be materially misstated is going to influence the decision of somebody. So do you think that is going to be same for both? Absolutely not. Materiality is a concept which is going to be different for the different organization. Therefore, it becomes very important for the auditor by understanding certain things to decide on a material level, okay, which is suitable for the particular organization that we are going to check. All right. So what we do is, let us take the example of a company like Tata, or let us take, for example, Reliance. And let us take any other business, maybe A Company Limited. Maybe it's a small company. We'll take a company like that. Okay. Or let us take a startup as the example. In this case, when you talk about a company like Reliance, do you think the comparison of the figures of a company like Tata, Reliance, and that of a mediocre or a small sized firm would be same? Absolutely not. Clear? So what we are going to understand here is, on what basis will the auditor fix the material level? And then based on that, we are going to assess whether a particular misstatement which we have identified is material or not. So if you take an example, like for example, if you take 50,000 rupees in case of a company like Tata, imagine we are doing the audit of expenses or maybe revenue, wherein we are vouching the expenses and there is a misstatement worth 50,000. Is this 50,000 going to really matter to an organization which is huge like Tata or Reliance? Absolutely not. So this is not going to be considered to be material. Therefore, when the auditor is going to perform the audit and he sees that there is an amount which is less than 50,000, which is 50,000, which is considered to be not very material item for him. Correct? So he's not going to go into detailed checking. He will not consider it to be an amount which is really going to impact his opinion on the financial statement. But you take like a company which is a startup. Assume this company which I've taken as an example is a startup. It is in the beginning phase. So in that case, don't you think this amount of 50,000 would definitely be material, be revenue or be expense? Don't you think this amount will definitely amount to material amount? Yes. So this standard is going to tell us that when the auditor is going to perform the audit, when the auditor is planning the audit, he has to fix a level. And that level usually is a monetary limit, which we call it to be a material limit, beyond which if a misstatement is identified, that misstatement we call it to be a material misstatement. And that is going to affect our financial statement decision or the opinion that we give. Clear? So now let us go and see the content that we have. All right. So here, if you look at it, SA 320, materiality in planning and performing the audit. So the standard very well tells that it is the auditor's responsibility that the auditor has to fix the material level at both planning as well as while performing the audit. So there has to be a particular amount which the auditor will fix, which he is going to consider to be important, giving emphasis to it, telling that if about this, any misstatement I identify, that is going to influence my decision of giving the opinion, or this I'm going to evaluate in detail. But if an amount which is below that amount, below the material level, we are not going to consider it for evaluation. The logic is very simple. It simply says that, are we auditors having all the time on earth to check each and every transaction? And do you think every single item of the financial statement is going to be material, is going to be important? Imagine there is an invoice of 100 rupee and you have corresponding other invoices of 40, 50,000. Are you going to give importance to that 100 rupee item, which is really insignificant and immaterial? No. So that is the reason we come up with the concept of materiality, and we have to obtain a reasonable assurance. What have you to obtain? A reasonable assurance that the financial statements are free from material misstatement. Okay. Having discussed all of this in materiality, now let us see how the auditor is going to come to a level of materiality. Okay. Now, the basic idea given here is that financial reporting framework. You understand the meaning of financial reporting framework? To give you a simple example, we have a financial reporting framework for a very simple understanding. Yeah. Financial reporting framework, that means, let us take the example of Schedule 3. Okay, the companies prepare the financial statement based on the Schedule 3. So Schedule 3 is the financial reporting framework based on which we are going to prepare the financial statements and present the financial statements. Basically, the concept of materiality is discussed in the financial reporting framework. For example, like if you see the disclosure requirement of Schedule 3, we know that if any expense is either 1 lakh or 1% of the turnover, okay, whichever is higher, we have to separately disclose it. You have to show it separately. You have to disclose it separately. So this thing is something which is telling us how a material level can be understood. Because materiality is something which, is going to affect the user's decision. So sometimes the financial reporting framework only tells you that these items are going to be material. So like Schedule 3 very clearly gives an indication that if an amount is 1 lakh or 1% of the turnover, whichever is higher, if any amount is like that range, then you please disclose it separately in the financial statement. So the FRF itself is telling you what? That this item is important for the users of the financial statement. Anybody who's going to read it will find this item to be material. So assume we have an expense, maybe an electricity expense or maybe any other maintenance expense. And if the amount, if assume 1% of the turnover is coming up to 5 lakhs. So whichever is higher, as in this example, we take it as 5 lakh. So for this company, let us consider this company to be A Limited. For this company, this 5 lakh is going to be considered to be material. And where is this discussed? In its financial reporting framework. Now, any item in the financial statement, which is going to be 5 lakh and above, will be separately disclosed. Correct? So that is one way of identifying what is materiality. So the auditor also will look into the financial reporting framework and see if there is any discussion given by it regarding the materiality concept. So if I am the auditor of the company and I look at the financial reporting framework, is this framework giving a discussion about materiality? Very much yes. So in that case, I could choose this to be my concept of material. That means that is the way I'm going to pick my material amount. So I would take 5 lakh to be the material amount. And then when any expense, any item, which I will consider it to be 5 lakh and above, will become material for me. And this assessment, I'll be doing it in detail. Clear? Then, if you look at the next part of it, okay. Okay, I believe everybody is following the class. Okay, so let's continue. All right. Yeah, I am teaching completely in English language, don't worry. Okay, the entire lecture will be delivered in English. Okay, all right. So with this, let us continue. Okay. Now, if you look at the am I visible to all of you? Yeah. Okay. So let us go back to our discussion. So what did I say? If a financial reporting framework is clearly defining the material level, then we are going to use it as it is. We could pick up that to be material. But sometimes the financial reporting framework does not discuss the concept of materiality. So in that case, how will the auditor decide what will be the material level for him? Correct? So this standard particularly gives us 3 things for us so that we can keep these things in our mind and then come to a conclusion of what could be material for a particular organization. Okay? So let us take one by one for our understanding. First, they say that the financial reporting framework often discusses the concept of materiality. So the financial reporting framework usually gives us an understanding that this is the concept of materiality. These are the items which we consider to be material. But suppose if the financial reporting framework does not discuss the concept of materiality, then in that case, what do we do? So these are the general things which the auditor will keep in his mind for him to decide what will be the amount which he will consider it to be material. First, misstatements including omissions are considered to be material if they individually or in aggregate could reasonably be expected to influence the economic decision of the user. Economic decision as in the business decisions or the important decisions of the users. So you will take into mind those things which if you feel if there is going to be a change here, then this is going to impact on the decision making of the user. All right. Like if you see if a misstatement of 10,000, 15,000, okay, this would genuinely not impact the user's decision. But yes, if there is going to be a considerable amount which is misstated, if you talk of a company which is mid-sized and you say 5 lakh amount is materially misstated, don't you think this is going to impact the decision? Like one more example to give you, if there are investments recorded in the financial statement. So the balance sheet is telling there are investments. But these investments in reality are actually unrealizable. Okay, they're not realizable investments. And these are appearing to be realizable. So in that case, don't you think this is something misleading? It is going to affect the economic decision of the user. Very much yes. So if some amount or some misstatement which has the power to influence the decision of the user, the economic decision of the user, that will be considered to be material. Correct? Then, second, we talk about judgment about materiality are made in the light of surrounding, also affected by the size and nature of the organization. Size and nature, I already explained it to you based on the companies like Tata and a startup. So here we are also going to give importance to the size. Size in the sense the volume of transaction, the level of organization, how big it is. Because if you compare a startup and you compare a company like Tata, there is no way they are going to be same. correct? So we are going to give all regard to the kind of organization, to the size, the nature, everything, and then come up to a material level, correct? So that is what we are saying. You're going to give importance to the surrounding, the size, the nature, correct? Because materiality is something subjective. What is material to you may not be material for me. And what is material for me may not be material for you. So as I said, 5 lakh may be immaterial for a company like Tata, but for a startup, it is a material amount. So we are going to give regard to the size and nature of the misstatement. Then we have a very interesting point for discussion. They are telling that judgment about the matters that are material to the users of the financial statement should be considered by taking into account common financial information need as a group. What do you mean by this? Now tell me, we have multiple users of the financial statement. Users of the financial statement are who all? Like we could say we have management. They will also use the financial statement maybe to decide on the expansion plans. We have government who's going to use the financial statement to decide our tax liabilities. Then we have the investors also who are going to decide whether to invest in our business or not. Correct? Then we have the employees also who will be interested in the financial position of the business. Okay, to understand their bonus and all of those calculations. So there are going to be multiple users of the financial statement. Now tell me, is auditor going to cater everybody's needs? Will he be in a position to understand each and every user's needs and then decide what will be material? That is not possible. Because there are so many users of the financial statement. If I cater everybody's need, if I try to take into account everybody's need, it is not going to be possible for me. This standard very clearly tells that, look, auditor, you don't have to cater or give importance to every individual need, not required. Instead, you are going to consider a common financial information need as a group. That means you consider the group as a whole and then you decide what would be material for them. Because tomorrow, understand, if a particular investor says that, look, auditor, because you said true and fair view, you said there are no material misstatement, I invested in the company, I lost my money. Do you think auditor is going to be accountable for every person like this? Not possible. Correct? So in that case, what we are telling, very simple. This standard only very clearly tells that, look, auditor, when you are going to go in for checking of materiality or determining the materiality, then understand that you are going to consider the common financial information needs. Correct? So basic idea what we have here is, first we will see whether a respective financial reporting framework is discussing the concept of materiality. If it is discussing, no problem, you will pick up as it is, and that only will become the material level for the auditor. Like I gave the example of 5 lakhs to you, so that the auditor can take as the material level. Correct? If suppose the financial reporting framework does not discuss the concept of materiality, then the standard SA 320 is giving 3 supporting things to the auditor. That, look, auditor, these 3 things you take into account and then decide what would be the material level for the particular organization. Correct? See, understand, materiality is purely a judgment of the auditor. Pure judgment, the professional judgment of the auditor. I told you, what I consider to be material need not be the same by you. You could believe 2 lakh to be material. I would believe 5 lakh to be material. So it is definitely going to be different for the different organization, different using the different experience of the auditor. It is purely the judgment. So this standard is giving you a framework for you to keep some important things in mind where you are going to use your judgment for the purpose of deciding material level. Correct? So if the financial reporting framework does not discuss, then 3 things are being told to us. First, you see which are those items which could actually have an impact of influencing the decision of the users, the economic decision of the users. Correct? Like economic decisions, there are debts which are actually bad, but then you have shown still as a good debts. These, the users will feel, yeah, everything is fine. There are no bad debts, so the amount is going to be received. Liquidity is good, and they will be having their investing decisions to be taken. So this item, don't you think is material? Very much yes. So see which are those things which are going to impact the economic decision of the users. So first we will consider that. Also see that you also take into account the nature and the size of the organization. Look at the nature. Is it already a growing organization? Is it textile? Is it manufacturing? What is the nature? What is the size? Is it a big sized, a huge organization, a listed company, or is it a sole proprietor, a small business? What is it? So we will see the size, nature, and then decide the material level. Third, we know as the auditors, we will not be able to cater everybody's needs. Not possible. So in that case, if that is considered, no, then every person will start coming to us. That look, because of you, we invested. You said no misstatement, no material misstatement. We did this, we did that. And people will start having some all legal repercussions on us. So better is the standard itself is giving a very clear indication. Look, auditor, you are going to cater common information needs. So common thing. We will keep into mind a common information need. Maybe if we believe this item to be important, like a revenue figure, then yes, that only will be considered. So we will take into account common, what is required, correct? So this is the way in which the auditor is going to determine the material level, correct? So this standard very clearly tells that such discussion, if it is present in the applicable financial reporting framework, adopt it. If it is not, then these three things will help the auditor to decide on the material level. But ultimately, whatever is given in the standard, it is the professional judgment of the auditor, the calculation made by the auditor based on his understanding that he will decide what is going to be the material level. Okay, now, let us now take one of the very important discussions here. We said that we are going to decide a material level taking into account the user's financial needs. The user's economic decision should not get influenced, or this has a power of influencing it, correct? So here there are certain presumptions which the auditor is going to make. Presumption as in we are going to give the audit report and we believe that the users of the financial statement have all this following knowledge. Okay, that means they understand how the audit has been conducted. First, we believe that they have a reasonable knowledge of the business, the economic activities, and they understand the financial information with reasonable diligence. Reasonable diligence as in they properly understand the financial information. Okay, so they are having a reasonable knowledge of the business. That is what line of activity it is, what business they are into, what is the nature of the industry. They have a knowledge of it. Then they also understand that the financial statements are prepared, presented, which is done by the management, and audited, which is done by us, keeping the mind materiality level. That means we are telling we have done the audit, keeping into mind the material level. That is, immaterial items we have not considered. So we are not telling they're 100% free. We are telling what? They are free from material misstatement. So the users have to understand that the preparation has also happened keeping in mind material level. Audit also has been conducted keeping into mind material level. Then they should also understand that there are inherent uncertainties. Like we have estimates, we have provisions, we have multiple estimates which are made, which there is going to be some kind of calculation is going to be there. So tomorrow the real figure could be different. So it is inherent because it is purely a calculation. It is an estimate. An estimate itself says it is not correct. It is precise, or cannot say it is precise. Okay, it is going to be something probable or something near to it. So only we call it estimate, right? Correct. So the users have to understand that the financial statement includes estimates and judgments, and these could have changes taking into account the future events. And finally, make reasonable economic decisions. Okay, that means you should understand that the auditor has taken into account only those material items. Immaterial have been ignored. Keeping into mind, you also take the reasonable decisions accordingly. Correct? So these are the things that we keep in mind, and we understand that the users of the financial statement also realize that the audit is conducted keeping into mind the material level. All right. So that was the beginning of it. Okay. I understand the beginning itself was quite long, but very interesting. This is to know because many students happen to skip the initial part because they find the language to be heavy. But trust me, this is the basic idea, okay, which you should know. Okay. Now let us get on with the main crux of the standard. Okay. Now, I will just take you to the name SA 320, which is telling you materiality in planning and performing the audit. Why did I repeat it? Because now we are going to understand something very important. Materiality is a concept which the auditor is going to decide, or it is an amount which the auditor will decide at the planning stage, And also, he will take into account when he's actually performing the audit. Okay, now, when you start the audit, you basically start with the planning. Correct? So in the planning stage, by taking into mind all the things that we discussed now, that is the FRF, and if the FRF is silent, the other three criteria, keeping into mind that you will have a plan to be done where you are going to fix the material level. This material level, we call it to be overall materiality for the financial statement as a whole. It is the overall material level. So let us take the example of a business A Limited. So by taking into account the discussion that we had now of how to pick the material level, maybe we have picked up 1 lakh to be an amount which is material. Okay. So as per our discussion or as per our understanding, we have decided 1 lakh to be the material level. This 1 lakh is considered to be the overall materiality for the financial statement as a whole. So the auditor will fix a material level in the planning stage, okay, which we call it to be overall materiality. And this is going to be for the financial statement as a whole. That means for the organization A Limited, every item or every misstatement which you identify, which is going to be 1 lakh and above, is going to be considered to be material. Is going to be material. That means the auditor is going to evaluate the misstatement, and this will have the impact on the opinion. Correct? That means 1 lakh and above, these misstatements or these transactions we are going to check in detail. This will impact our opinion as well, or when we evaluate, it is going to have an importance. The items which fall below 1 lakh, we are going to consider it to be immaterial. So if an amount of 80,000 is there, 70,000, 60,000, these we are going to consider to be immaterial, and this we will be not considering for a purpose of evaluation. So this 1 lakh, the auditor will fix at the stage of planning, which we call it to be overall materiality level in the planning and performance in the planning of the audit. Okay, that is financial statement as a whole. Now, this is done when? In the planning. Correct? Now, next comes to performing. Now, what do you mean by performing the audit? Why we require materiality there? Okay, now listen to this very carefully. Understand logically, concept is very simple. If you look at the figure of 1 lakh, tell me, you as the auditor, your understanding is that 1 lakh and above misstatements are what? Material misstatement. So we are going to check them in detail, and this is going to impact our decision making. That is the opinion that we are going to give. Any amount below 1 lakh, we are going to disregard, we will not consider. Okay, now understand properly. There is a misstatement which you identify, which is worth 95,000 rupees. Okay, maybe let us take, we are checking sales, we are checking the revenue. We have kept 1 lakh to be the overall materiality level. So any item or any misstatement above 1 lakh, material, below that, immaterial. Okay, now there is a particular invoice of 95,000. So according to your understanding, it is what? Immaterial. Correct? Another 90. Again, it is less than 1 lakh. So it is going to be immaterial. We are ignoring. 85,000. Again, immaterial. We'll ignore it. Now tell me, if these amounts you totally ignore, really give absolutely no regard to these items, don't you think you are giving a rise to the audit risk? A risk that you could end up giving a wrong opinion? Absolutely yes. Why? Because these items, I do agree, they are following below the material level. But don't you think if you take the aggregate of all of this, is it not crossing the overall material level? Yes. Correct? So what happens is, the first limit which is fixed at the planning stage, which we call it to be overall material level, which is for the financial statement as a whole. But then when the auditor really performs the audit, when he actually goes in the field to perform the audit, he does not start from 1 lakh. He actually starts from an amount below 1 lakh. Okay. So assume you are checking sales. So what you will do is, you will actually, when you're performing the audit, you will start checking the transaction below 1 lakh actually. That means let me keep a limit of 80,000. Okay. So what you do, you will basically start checking the transaction involving the amount of 80,000 and above. What is the basic idea behind it is very simple. 1 lakh is my material level, but I actually, while performing the audit, I will start from where? Lesser than that amount. Let us take, we have kept 80,000. Now what happens is, suppose if I've got a misstatement in 90,000, will I consider? Yes. If I got something in 95,000, will I consider? Yes. If I have something in 85,000, will I consider? Yes. Why? Because individually these items are not material. I agree. Individually, items are not material. But when you collectively take all of them, when we aggregate all of them, don't you think it is actually crossing the overall material level? Yes. So basic idea is that the 1 lakh limit is actually getting crossed. And because of which, don't you think the aggregate of these misstatements will be material for our understanding? Yes. So this limit of 80,000, which the auditor has kept, other than the overall materiality level, which is below the overall materiality level, is considered to be performance materiality. What is it called as? Performance materiality. So that is the reason the name of the standard says materiality in planning, where you do overall materiality. And while you're actually performing the audit, you will have performance materiality. And this performance materiality is going to be an amount which is going to be lower than the overall materiality for the financial statement as a whole. And we fix it for the purpose that the audit risk, that means the probability of we giving the wrong opinion, is actually brought a little lower. Obviously, risk cannot be eliminated, right? There is always going to be a risk. But by doing this exercise, don't you feel we are going to bring the audit risk to even more lower level, to an acceptable lower level? Yes. And that is the reason, though while planning, we fix the material level, while actually performing the audit, we are going to start at a level which is going to be lower than the main overall materiality. Reason being, there is a possibility that individually there could be certain items which could be immaterial. But when you collaborate, when you collect all of them, when you aggregate all of them together, they are going to be what? Material. So because of this, just to reduce, just to bring the audit risk to some more lower level, that is the probability of a misstatement to go undetected or uncorrected, to bring it down, we will also fix another level, which we call it to be performance materiality. Understanding? So basic idea is overall materiality for the financial statement as a whole, we do it in the planning stage. And performance materiality is when we actually perform the audit, when we are performing, when we are using the procedures to do the audit in reality, when we bring on the field of the performance of the audit, we start from a little lower level, which we call it to be performance materiality. Correct? So now let us see how the standard is defining the performance materiality. Performance materiality means the amount or amounts set by the auditor. Amount or amounts. Why amount or amounts? Understand, for every item, you could not keep the same performance materiality. Suppose if there is a transaction like related party, don't you think the risk is very high? Yes. So if you are keeping 1 lakh to be your overall materiality level, according to me, my professional judgment says, for related party transaction, I would actually start checking from 20,000 only. So depending upon the risk involved, the type of the information, the performance materiality could change from account balances, transactions to transactions. I would give importance to the risk, and because of which it could change. So if you saw in my previous examples, I kept for sales 80,000 as the performance materiality. Here I'm keeping related party to be 20,000. That means my beginning, I'll start checking from what? 20,000 only. And for me, every item 20,000 and above for related parties would become what? Material, which I will do the evaluated, I will do the checking in detail. Similarly, sales I'm starting from 80,000. I believe the risk could be a little lower compared to related parties. Correct? So what they're saying, performance materiality means the amount or amounts. So here two amounts, correct? Set by the auditor at less than the materiality level for the financial statement as a whole. So 1 lakh is my materiality level for the financial statement as a whole. And this amount is less than the materiality as a whole. Why? To reduce to an appropriately lower level the probability that the aggregate of uncorrected or undetected misstatement would exceed the materiality level for the financial statement as a whole. Got it? So they are telling we are trying to reduce the probability that these figures like 80, 85,000, 95,000, 90,000, these if you aggregate them together, these could cross your material level, which was set by you for the financial statement as a whole. So it is crossing 1 lakh. So because we should not ignore it, we are going to keep another level, which is called as performance materiality. So the reason for performance materiality is very simple. It is to reduce to an acceptable lower level the probability, that is the risk, that the aggregate total of the uncorrected and undetected misstatement exceed the material level for the financial statement as a whole. Did you understand? And understand one more point here. You could keep different performance materiality for balances, for transactions, for disclosures, anything you could keep it separately. It is no hard and fast rule that performance materiality should be one fixed amount. No. These are amounts based on certain factors like, like type of industry. Like if you take a company like pharma, R&D, very important. So their performance materiality could be very low. So when you check the research and development expenditures, these you'll start from very low checking. I mean, you'll keep a material level very less. And from there, you'll start checking. Similarly, if you look at the organizations and you see that, yeah, risk is the risk of material misstatement, like related party. The risk is very high. So there, we will keep the performance materiality a little lower, correct? So it could be different for different class of transactions, for different balances, for disclosures, you could keep differently. It is no hard and fast that one performance materiality only should be kept, correct? Balance means balance sheet items. Transactions we call P&L account items. Disclosures are notes to accounts. So these are overall what? The financial statements, correct? Then one very important point of discussion again here is regarding this standard is going to give you something of a methodology of how you are going to calculate the material level for the starter. Like when you plan the audit, what would be the method that you could use for the purpose of deciding the material level? Okay, now this concept is basically considered to be, we call it to be using the concept of benchmark. What is it called as? Benchmark. So what is the meaning of the word benchmark and how are we going to use this concept for the purpose of determining the material level? Okay, material level as in how did I come to the 1 lakh figure? How did I come to 50,000 figure if I take it? How did I choose this? How is the study done? How is the auditor applying his judgment? He will use the concept of benchmark. Okay, now materiality basically is a completely judgmental decision, a purely judgment of the auditor. But this standard will help the auditor in coming to a conclusion. Okay, now auditor will pick one of the item of the financial statement. Depending upon the industry, depending upon the nature of the organization, the size of the organization, depending upon which item the users will be very interested in. Okay, one of the item will be picked up from the financial statement. So financial statement, you will have assets, you will have liabilities, you will have income, you would have expense, correct? You will pick one of the elements of the financial statement depending upon the organization. Let us, for a simple understanding, assume the major stakeholders of yours or major users of the financial statements are equity shareholders, correct? So equity shareholders definitely would be interested in profit after tax. Obviously, they'll be very interested. So the users will be interested in profit after tax. So what we will do, we will pick the element profit after tax for our purpose of a benchmark. So we will pick PAT to be our benchmark. Okay, now What benchmark? What are we doing? Okay. Now what we do is this amount of PAT, okay, assume it is 100 lakhs. We will consider it to be a benchmark. That means we are keeping in our mind as a base for a calculation of benchmark. On this, we will, that is the auditor will apply a percentage. This percentage is going to be purely the judgment of the auditor. Assume the auditor applies 1%. So now on this PAT amount, this 1% is applied. So we get 1 lakh. Now this 1 lakh would be considered to be material. Got it? So what happens is this standard tells, look auditor, you can use the concept of benchmark for the purpose of calculating the amount of materiality. That means this percentage of 1%, that is this 1%, will be applied to the benchmark that you are selecting, and that amount which we derive will become our material level. This is which material level? The overall materiality level for the financial statement as a whole, which we are doing where? Planning stage. Based on that, our performance materiality will be discussed, which is going to be below 1 lakh for our discussion. Clear? So this concept of benchmark, when you use, there are certain factors that you keep in mind while choosing the appropriate benchmark. Whether your assets will be your benchmark, whether liability will be your benchmark, share capital will be the benchmark, sales figure is your benchmark. Okay, what item in the financial statement could you take as the base for the calculation of your materiality? For that, certain factors you keep in mind. So let us understand one by one, which are those factors. Very important discussion, exam-oriented question. Okay, so which are the discussions that we are having here? So how did you pick up an asset to be your particular benchmark? Or how did you pick a sales figure to be your benchmark? How are you going to decide that? Okay, let us have a proper understanding of it. So there are certain factors that we are going to consider. Give me 1 second. Okay, a very important part of our discussion today, where we are going to pick up use of benchmark in determining the materiality. That means we are going to pick up one of the item, and on that we are going to apply a percentage, and then that would be considered to be a material item. Okay, now, first the factors that you will consider is you will take into account elements of the financial statement. So you could pick an asset, you could pick a liability, equity, that is the capital, revenue, income, or expense. Any one of the item you'll pick up from the financial statement. This item, how will you pick up? What will help you? So next factor you will see whether there are items on which the attention of the users of a particular entity tend to be focused. Now I gave the example, right? Like for example, here we spoke about equity shareholders. So don't you think equity shareholders would be more inclined towards the profit figure? Yes. Their focus will be where more on profits. Investors, maybe they'll be more interested in the net profit, or maybe in the sales figure, correct? So there could be a possibility depending upon users' focus, where it is, that we have to take into mind to decide what should be the benchmark, correct? Nature of the entity. If you take a manufacturing business, okay, the item would be maybe asset. Their assets are considered to be very significant. If you take an organization which is into trading, sales could be considered, correct? So that is the reason we say nature of the entity also becomes important in choosing the appropriate benchmark. Life cycle, whether you're in the introduction phase, whether you have reached maturity, are you growing? That also you should consider while choosing your benchmark. See, if you take a consideration, like for example, if you are a startup, profit figure cannot be taken because this is cannot be considered to be something which is realistic or which is going to continue. Okay. Similarly, for a company like Reliance and all, which are reaching the growth phase, their profit could be considered, right? So depending upon the nature, the position, the stage of the life cycle where you are, based on that, you will pick which would be the benchmark. Entities ownership structure. If they are more of debtors, debt securities and all, then they'll be more concentrating on profit before tax rather than profit after tax, correct? So like that, you'll see the ownership structure. If equity shareholders, PAT, other investors are there, then PBT also will become important. So depending upon that, you will consider. Last, very important, relative volatility. What is relative volatility? That means, tell me, will you pick up a benchmark which is going to have a change every now and then? No. Choose a particular benchmark which is not going to be volatile, which is not going to change. Okay, that means if you take a company like which is a startup, a profit figure cannot be taken, because initially, at least the first 5 years, if you take, there is going to be a shift. It is not something which you can consider to be like a benchmark. A benchmark is something which we are going to consider to be have a stability in it. So volatility should not be a characteristic of the benchmark that you are choosing. But if you take a company like Reliance, can you take profit figure? Yes, because there is some kind of stability. There is some kind of, understanding that, yeah, this is the level. So that you can do. Understanding. So volatility, you should not, you should not take any item which is volatile in nature. And for startups and all, if you cannot take profit figures. These are going to be something not acceptable. They are going to change. So those places, we cannot use profit to be the benchmark. In those cases, we will consider sales figure, or maybe the shares, share capital, or maybe the contributions made by them. Those would be considered to be way better than using the amount of profit, which is going to have a change. Correct? So these things you keep in mind when you're choosing a benchmark. So that is going to be, it should be element of the financial statement. That item which the user is going to be more inclined to be focused, nature of the entity, the life cycle where it is in. Then you also take the entity's ownership structure into consideration. Okay, the way it is financed, and it should consider the volatility. It should not be the one which is changing every now and then. Correct? After taking into account all this, you will pick up one of the benchmark. Assume after all your factors considering, you picked up assets to be your benchmark. Then the auditor will apply a percentage, which is going to be purely his judgment, the experience of the auditor or the understanding of the auditor. Maybe he's putting some percentage like 1%, and what figure he derives, that will become your overall materiality level for the financial statement as a whole, which you decide in the planning stage. Correct? And then performance materiality could be an amount lower than that, and that could be different for different items. Is the concept clear? So that is about how you decide about your important item, that is your benchmark. One last important thing which I consider about the standard is they have given you a relationship between audit materiality and audit risk. Very interesting thing. Many students don't get the concept correctly. Okay, I'll just make you understand this properly so that the concept sinks in properly with you. Okay. Okay. Listen to this carefully. Audit risk, materiality, what is the relationship? Many of you, if you have already read some time or you have any knowledge about it, you know there is inverse relationship. What do you mean by it? Okay, understand. Audit risk, okay, or we can say that, just 1 second. All right. Audit risk is basically having 3 components. Inherent risk, plus you have control risk, plus you have the detection risk. These two together, we call it to be risk of material misstatement. If you understand the concept correctly, what is the logic is that if the risk of material misstatement is very high, then you have to keep detection risk to be low. Only then audit risk also will come down. If the risk of material misstatement is high, you have to bring your detection risk to be at lower level. Only then your audit risk will come down. Correct? Now listen to the concept carefully. Suppose if you have identified the risk of material misstatement is high. Correct? Then. And if risk of material misstatement is considered to be high, then obviously you are going to keep material level to be low. Correct? So you have to keep material level to be low. So what will happen here is risk of material misstatement, if it is going to be high, that means you know that there are a lot of misstatements in the particular area. So if you take the example of debtors and you believe that yes, the risk of material misstatement is going to be high. So in that case, what you will do? You will keep material level to be low. Correct? Why? You have to now check more number of transactions. Correct? So what happens when your assessment of risk of material misstatement is done as high? That means you believe debtors are materially misstated. So you will keep the material level to be less. So you will start from checking from a smaller item because you know risk is very high. So you want to do more checking. So what you will do, you will keep the material level what? Low, correct? Because you have to reduce the detection risk. When you check more number of transactions, only then detection risk will come down. And if detection risk comes down, then only audit risk will come down, correct? Because of which what we say, when the risk of material misstatement is high, materiality level should be low, correct? Similarly, if risk of material misstatement in a particular transaction is low, then the material level should be high. That means I believe maybe in sales, misstatements are not there, or you believe the probability of misstatement is less. So what you will do? You will keep a high material level. So you will check fewer transactions. So detection risk will be there, but your overall audit risk will come down, correct? So we say that audit risk and audit materiality are inversely related. Did you get the concept? Once again, if there has been a confusion, the basic idea of audit risk is what? Inherent plus control and detection, correct? So when we say risk of material misstatement is high, we have to bring down the detection risk. Only then audit risk will be low. Our overall idea of audit is what? To bring the audit risk to an acceptable lower level, correct? So when we did the assessment of risk, we understood that risk of material misstatement is high, assume. So we will keep material level low so that we can check more number of transactions. So we are actually bringing the detection risk down. So the overall audit risk is come down, correct? So what they say, that audit risk and materiality should be inversely related. The relationship is what? Inverse relationship. Got it? A very important point of discussion in this standard. Okay. One more thing to last, or the last part, which I would consider to be very important as of now for our discussion, is that revision of materiality. Tell me, planning itself is something which is going to be continuous. So don't you think when planning is continuous, planning a material level itself is a part of what? Planning, right? So what happens? We cannot say planning is something which is rigid. It cannot change. So when planning can be flexible, as and when the audit progresses, when planning can undergo a change, don't you feel while the auditor is doing the audit, all the new situations which he encountered, maybe new risk he assessed, maybe new items he came across which he did not know earlier, can he revise the material level? Obviously, yes. And when he revises the material level, as and when the audit progresses, don't you think the nature, timing, and extent of further audit procedures also will change? Yes. Got it? So what happens is there can be revision in the audit materiality. And as the audit materiality changes, obviously, if the overall materiality level is changing, performance materiality also could change. And if suppose the auditor brings the materiality level down, okay, then you have to reassess even the performance materiality, because performance materiality should be an amount lower than overall materiality, correct? So revision can happen as and when the audit progresses, you can go in for revision. Okay, it can be changed. So this is a simple idea which I wanted to give all of you through this short understanding of SA 320. Now you are open for your doubts or any discussion with me. Okay, so the doubts that I have here. Give me 1 second. All right. Okay, so let's take up the doubts one by one. Yes, thank you so much. The level of performance materiality is different for different items. Yes, I told you, keeping into mind the risk assessment. Okay, if you believe the particular item is very risky, you could keep a lower materiality level. If you believe some of the items are statutory disclosures, you could keep a lower materiality level. Sometimes the industry such that the items would be imported. So depending upon the kind of organization, the nature, you could have a different materiality level for different things. All right. Okay, you are open for discussion with me? Yes. Any other doubts? All right. Done? Okay. Did you all actually understand the concept of materiality properly? Was it understandable? Okay, I'll just try to give you the crux so that you actually get the understanding. Okay. Elaboratively, we'll be doing it again. Okay, so you'll be understanding it even better. But as of now, I think this would be suffice for you to get the concept. All clear. Okay, that's so good to hear. Okay, so I think with this, we are done with this session, and I just believe everybody has understood it properly. And if there is some more doubt, I can wait for us 10 seconds. If there are, you can raise the doubts to me. I'll get it clarified immediately. All right. Yeah, I did teach in English only, I believe. Yes. All right. So with this, I think we are done with the session. And I really hope that you all have understood it properly because I had a great time interacting. Okay. And I really wish that you really understood it because that was the essence of the session that was there. All right. So thank you. I'm just closing the session here. Okay. Yeah. Thank you. All right.